we're going to cover, and just like we did with Chapter 1, we'll go through some of the PowerPoint, we'll pause, we'll go through some of the problems or exercises. For this week, I believe you have problems 1 through 5. We probably will not be able to cover every one of them, but problem 5 is a really big problem, and I will probably put that on a lecture for you because I would not expect you to be able to grasp all that in one setting. We'll go through as much as we're able. So, Chapter 2, in Chapter 1, we understood what various types of transactions are, business transactions, are any type of transaction, but economic transactions are those that involve an exchange in your economic condition. So what we're going to do in Chapter 2 is continue on with that concept of various transactions, and we're going to start talking about how we go about analyzing those and what we do with various transactions. So in this chapter, we're just going to start out, and again, know that you can stop me at any time. A couple concepts that you're going to want to be familiar with. The first one is called recognition. When do we record a transaction? It's the when we do it. So for example, we order office supplies. Do we record that transaction when we order office supplies or when we receive the office supplies? That's what we're going to talk about. Recognition is the when. Valuation is how much. So the valuation is determining the monetary value we are going to put on a transaction. Classification is where. Where are we going to assign these transactions? What category? Or as we're going to learn, what account are we going to assign to the various transactions? So know the three, the valuation, the recognition, and the where. What was the last one called? The classification. Okay, those are the three specific items that we're going to look at with each one of these transactions. Business transactions are economic events. Okay, so they're saying here all business transactions are economic events that we need to record. So the recognition, the valuation, and the classification are the three key items that we're going to need to focus on for every single transaction that we talk about. No matter what business, we're always going to focus on those three transactions. So we've got an economic event. We've got to determine when we record it, how much we're going to record that event for, and where do we record that? What accounts do we use to record those transactions? Ultimately, any economic transaction is going to alter or affect the financial position of a company. It's going to change that balance sheet the minute you record a transaction. When to record a transaction? For recognition, companies usually set specific recognition policies, such as most companies do not recognize income or revenue until those goods transfer title to the buyer. So for example, I purchase a couch. I pay for the couch. I am going to purchase the couch. They're going to deliver it. Does a company record the sale of that couch the minute I give them the money? Or do they record the sale of that couch when they deliver it to me? Generally speaking, a sale occurs when the title transfers from the seller to the buyer. Make sense? Because it's been completed. So each company has their own set of rules regarding when transactions occur. Generally speaking, when does the risk pass from the seller to the buyer? That's generally when the sale has occurred. So in other words, I purchased that couch and the store has a fire. Do you think I'm going to get my money back? I better. Because I wasn't in possession of that couch, was I? Do you see what I'm trying to say? Recognition refers to the decision as to when to record a business transaction. Deciding when to record a transaction is important because the date on which a transaction is recorded affects the financial statements. So if I purchase that couch on December 31st, but they deliver it on January 2nd, when are they going to show that revenue? On the 2nd. When will they take it out of their inventory and show it sold? On the 2nd. Do you see what I'm saying? Valuation assigns a monetary amount to that transaction. And by assigning a monetary amount, it's going to ultimately affect our assets and our liabilities, which we'll get at in a minute. GAAP, generally accepted accounting principles, are those guidelines we go by in the United States. Generally accepted accounting principles give us specific guidelines as to how we should record certain transactions. GAAP states business transactions should be valued at the fair value when they occur. Fair value means the exchange price of an actual or potential business transaction between market participants. So let's just say that I make a transaction and with Cecile, and I sell Cecile my ring, and I sell it to her for $500. Can I say, but you know what? I gave her a deal. It's really worth $5,000. What did I sell it to her for? What does the paperwork show? 500. Oh, but my appraisal shows 5,000. So what? What was our exchange? Make sense? This is a big questionable item. People always come to me when we do income taxes because they'll say, well, I got it for this amount, but it's really worth this. Doesn't matter. What did they pay for it is what you record. Okay? Make sense? So valuation is the fair value in the exchange. Recording transactions at the exchange price is called the cost principle. The cost principle means we record things at what truly we paid for things. So if a building was purchased 20 years ago for $50,000, okay, even though today it might be worth $500,000, the books are going to show 50, give or take improvements and repair. You know what I'm saying, improvements. But it doesn't matter what it's worth. What did you pay for it? Okay? So important to know that. And I think it's a fairly easy concept because what's the paperwork say? That's how I always know what to record. What's the paperwork showing me? Classification is the process of assigning all the transactions in which a business engages to various what we call categories or accounts. So if I am purchasing supplies and I receive those supplies and I'm going to pay the $300 for those supplies, what happens when I pay $300 for supplies? I'm now receiving supplies, that's the category, for $300, and I use cash to pay for it. So I'm going to also reduce my cash. Make sense? One of the most important classification issues in accounting is the difference between an expense and an asset. Guys, I gave you a really big hint last week. What's an expense? It says what? Y'all remember that? Don't forget that today, because that can be tricky on you. No, an expense will say expense. An asset will be cash, accounts receivable. What other kinds of assets did we talk about last week? Supplies, equipment, buildings, furniture and fixtures, patents. Okay, those are assets. Expenses get used up. At the end of the cycle, there's nothing to show for them. Assets, there is a future, do you remember the word? Benefit. Okay? Proper classification depends not only on correctly analyzing the effect of each transaction, but also on maintaining a system of accounts that reflects that effect. So let's look at our little apply it deal. Three major issues underlie every accounting transaction. Recognition is when. Valuation is how much. And classification is where. Match each of these issues to the statements that are most closely associated with the issue. Number one, records a piece of equipment at the price paid for it. Valuation. Number two, records the purchase of the equipment on the day on which it takes ownership. Recognition. Number three, records the equipment as an asset because it will benefit future periods. Classification. Guys, this is so important, okay? You'll know where, how much, and when. Does that make sense? If I go too fast on an area, will you slow me down and say, hey, stop? Okay? Or go over it again? Please do that. You will see those three items again. Okay? In a multiple choice. Recognition means A, B, or C. Recognition means when we record it. Classification means what account we record it to. And valuation means how much. Okay? So, now we're going to start talking about recording business transactions. In accounting, we have what's called a double entry system. The reason we have this double entry system is because every transaction has two sides to it. Okay? So in this double entry system, each transaction gets recorded with at least what we call one debit and one credit. And the total amount of debits and credits have to equal. So it's easy. So every transaction, we're going to debit something, we're going to credit something. And our debits always have to equal our credits. This duality principle means that every economic event has at least two aspects that offset each other. Sometimes they have more than two, but they're always going to have two aspects. Okay? So I introduced a word debit and I introduced a word credit. Hold on to that thought, okay? Accounts are where we store our information or where we record them. Remember the category classification. Accounts are the basic storage units for data and are used to accumulate amounts with similar transactions. So we have this accounting system. Every company has one. And this accounting system has all these different types of accounts. And depending on what kind of business, they're going to have assets, they'll have liabilities, and they'll have owner's equity. And the various types of accounts may be different just depending on what type of business they're involved in. Every business is also going to have revenues and expenses. Now, let's just refresh a minute. Assets, liabilities, and owner's equity, those three types of accounts or classifications show up in what financial statement? Assets, liabilities, and owner's equity show up in the balance sheet. Revenues and expenses show up in the income statement. Remember that. I'm going to keep telling you that over and over again. Okay, so these various accounts are going to be where we house information. Cash is an account. That account is an asset though, isn't it? Right? Rent expense is an account. So whenever we have a transaction where we pay rent, we're going to show that that transaction into rent expense, isn't it? But that account is what kind of category? Rent expense. Expense. Companies make money. I'm getting ready to start doing income taxes, so we have tax preparation fees earned. That's revenue, isn't it? But that's just my business. Education or schools have tuition. That's their form of revenue. See what I'm saying? Tuition earned or tuition fees collected. Every company has different sales. So depending on if you go to Macy's, they're not doing tax preparation. They're not providing education. You're purchasing goods. So those sales will be a result of purchasing goods and them selling goods. But sales would be an account, and the category would be revenue. Does that make sense? An account title should describe what is recorded in the account. So we'll want to make it really clear. Rent expense makes sense. We're only going to house things where we paid a rent expense. Utilities expense is where we house when we pay bills for electricity, water, gas. Make sense? Legal expense is generally a category that we'll utilize when we pay an attorney fee bill, right? In a manual system, each account is kept on a separate page or card, which are placed together in a book or file called the general ledger. The same thing works for a computerized system. That group of accounts that are all housed together is also called a general ledger. My very first job I had in 1982, I worked for a mortgage company, and we literally had this huge green book. I mean, seriously, I look back and just go, my God, how'd we do it? And each page was an account. And so whenever we paid a bill, I would have to go and record the debits and the credits in this big book. Can you imagine the mistakes I made? The addition and subtraction? And then you're off and you can't figure out where you're off. Fortunately, in this day and age, we have computer systems, and so they add for us. Thank God. But we can still make mistakes because we might classify them to the wrong accounts. But all the adding and subtracting is done for us. So the grouping of accounts a company uses is called the chart of accounts. You're going to see that again. A chart of accounts is a table of contents for the ledger. It lists the account titles and the numbers that have been assigned to them. It usually lists the accounts in the order in which they appear in the ledger. So, as you see on this chart of accounts here, the first one is cash. What type of category is cash? Asset. And you'll notice they're all grouped, the categories are grouped together. The second one is notes receivable. What category is part of notes receivable? Future money to come in, which is also an asset, isn't it? The next one are accounts receivable. That's future money to come in, but those are generally due from customers. Office supplies. What are office supplies? What kind of category? Good. Prepaid rent is something we haven't talked about yet, but I'm just going to bring it up for now. Let's say we lease an office building and we have to pay $1,500 a month. But we had some money, so we went ahead and paid the year all up front. Okay? Now think about this. Let's just say we paid a year up front, $18,000. We wrote a check for $18,000 and we gave it to the landlord. It's not an expense until we use it up, right? So prepaid rent, when we write that check for $18,000, we're going to look at, when we talk about accounts, we're going to put that in prepaid rent and we'll reduce our cash. Now, once the first month is done, we've used up a month, haven't we? So we don't have $18,000 in prepaid rent anymore because we've used up $1,500. So we'll reduce our prepaid rent. And where do you think we'd put it? It's now an expense, rent expense. Do you see what I'm saying? We can't write off an expense until we've used it up. Insurance is the same way. A lot of times people will pay insurance 1 and 2 years in advance. But insurance gets used up every month or every year. So when we pay an insurance bill 3 years up front, it's an asset. It's prepaid insurance until we use it up. Does that make sense what I'm telling you? So I'm introducing a new type of an account called prepaids. It's money, it's their expenses we've paid up front, but they haven't come due yet. Okay? Prepaid rent, prepaid insurance, land is an asset, buildings are an asset. We'll talk about accumulated depreciation down the road. I don't want to give you too much yet. Now, do you see various liabilities? Notes payable. What is a note payable? Money we owe to others, don't we? Accounts payable. Vendors we need to pay. Unearned revenue is something that we're going to talk about down the road. I'm not going to bring that up yet. Wages payable. How many of you guys work for a company and on December 31st, they're going to finish out their books, okay? But the pay period isn't until January 2nd, okay? Your wages, you've worked for it. The company knows they need to pay you. The year is ending for them. Now, you will get paid January 2nd, but the end of the year is December 31st. So they need to accrue what they really owe you. Do you understand what I'm saying? Because at the end of the year, you have earned, they've incurred that expense and they owe you that money. You'll get that money in the next year, but you need to match expenses in the period in which they've been incurred, not necessarily because you've paid for them. So we'll talk about that. That's why we might see a wages payable here. Now, look at owner's equity. For now, when we think of owner's equity, we're going to think of the capital that the owner contributes. We also will think of everything they take out of the company. And then, for now, the monies that come into the company, the revenues, I should say, increase your owner's capital. And the expenses, those costs that are incurred that go out of the company, reduce your owner's equity, don't they? So for right now, we're going to look at revenues, increase owner's equity, and expenses, decrease owner's equity. Because ultimately, revenues minus expenses equal net income. And do you remember last week when we dealt with owner's equity? We added net income into owner's equity, didn't we? So all we're doing a little different this time is we're taking all the detail, the revenues and all the expenses. Ultimately, that will equal net income. But I want you to think revenues increase our owner's equity, expenses decrease our owner's equity. Okay? How you doing so far, guys? So let's take a break here and let's look at a problem. Let me pull up my computer's slow. Come on. Boy, oh boy. Okay. There. I was trying to sync my iPhone yesterday. Maybe that's what's slowing down my system. Okay, get rid of that. Okay. Sorry, guys. What book is this? Principles, Needles, right? Okay. Let's look at a problem. The first exercises, can you help me? Tell me what page they're on.
74.
Thank you. Okay, so let's look at, how about SE1, okay? So as you see your little worksheet, you can fill in what you'd like on your worksheet. SE1, again, your homework problems will only be problems 1 through problems 5, but we're going to go over a lot of exercises because that's how you learn. Who would like to read? Well, I'll just start.
That's on page 69.
That's 69. Tell whether each of the following accounts is an asset, a liability, a revenue, an expense, or none of these. Who wants to take accounts payable? What is that? Liability. Why is that a liability? A future sacrifice. Number 2, B, supplies. Asset. C, withdrawals. Now think about that a minute. Where do we see withdrawals? Owner's equity. So it's not an asset, it's not a liability, it's not a revenue, and it's not an expense. It's part of owner's equity, isn't it? Fees earned. Think about fees earned. That's what's going to happen to me when I start preparing income taxes. I'm going to have revenues earned. What is that? Revenue. Does that make sense? We're earning them. Maybe circle that word earned, okay? Fees earned. Supplies expense. Expense. Accounts receivable. Revenue. Receivable. Oh, excuse me. What am I saying? I'm listening to you. I'm not paying attention. Accounts receivable. Asset. Unearned revenue, I haven't talked to you about yet, but it's basically going to be called a liability. I'll tell you why. Have you guys ever gone to an attorney and they want you to pay money up front? So you want them to handle a court case for you or a divorce. And they say, we want $5,000 up front. They haven't done a thing for you, have they? Do you know what that is to them? Unearned revenue. They're holding your money, but they have not yet provided the service. So technically, it's a liability to them because they need to do something in order to be able to claim that as revenue. Make sense? So unearned revenue is going to be revenue one day, but right now it's not. It's money that they're holding, but they need to perform some future sacrifice in order to, that's why it's a liability. It's a future sacrifice. They've got to do something in order to, as a result of that unearned revenue. So unearned revenue is a liability. How about equipment? Asset. Great. So SE2, tell how the concepts of recognition, valuation, and classification apply to the transaction that follows. So we're showing cash. We show cash of $1,000. is a credit, and we show supplies of $1,000 is a debit, and we show June 1st. What would show recognition? June 1st. What would show valuation? $1,000. And what would show classification? The cash and the supplies. That would be the classification. Got it? Okay. SE3. Which of the following events would be recognized and entered in Hallmark Company's accounting records? On January 10th, Hallmark places an order for office supplies. Has an economic event occurred? No. So nothing would happen. On February 15th, Hallmark receives the office supplies and a bill for them. Has an economic event occurred? Yes. They receive something and they owe somebody. So the event would be recognized on February 15th. Supplies would increase and they would have an accounts payable, wouldn't they? Because they owe money. On March 1st, Hallmark pays for the office supplies. Is that an economic event? Yes. Why? They exchange cash, right? So their cash was reduced, and they no longer have that payable, do they? Because they paid it off. Make sense? Okay, so let's move on to back to the PowerPoint. Okay? So, back to the PowerPoint. We're going to start talking about something called T accounts. Really, it's just an easy way for us to kind of process transactions. T accounts are basically a way we analyze transactions. It has three parts. It has a title. It has a left side, and it has a right side. When we were just looking at this one exercise, do you see over here where it says cash? That's a T account. You see it says cash. The left side, what we call the debit side. The right side is what we call the credit side. Okay, that's a T account. We showed cash, which is the title. Over here, here's another T account, supplies. We showed a debit on the left side and a credit on the right. That's what we call a T account. So, T accounts have three parts to them. It has a title, the left side, and the right side. When we talk about the word debit, all it means is left side of a T account. When we talk about the word credit, all it means is the right side of a T account. So you can see here, this T account is for cash. For a cash account, receipts, money's coming in, receipts are recorded on the left side or the debit side of a T account, and payments are always recorded on the right side or the credit side of a T account. So when we have cash, when we increase cash, we debit it, which just means show it on the left side. When we decrease cash, we credit it. Okay? Pretty straightforward, right? Think of a debit as left and a credit as right. So as you see here, we add up our debits, we add up our credits, and we have a balance, don't we? Our balance is a debit balance, right? Cash should always have a debit balance. Okay? Don't write that down. The difference between the total debits and the total credits is called the account balance. So as you see here in this cash, we had some deposits of $103,000. We had some checks or reductions of $71,600. But our ending balance is $31,400. That is our account balance. And for cash, it's showing up as a debit. The double entry system follows two rules. Every single transaction we are going to do always affects a minimum of two accounts. Total debits must equal total credits. For every transaction, one or more accounts must be debited, or we call it entered on the left side of the T account, and, not it or, but and, one or more accounts must be credited and entered on the right side of the T account. So remember how we talked about last week our accounting equation? Assets equal liabilities plus owner's equity. Remember that? When you think about this, remember cash? If you look back on your notes right there, when we increase cash, what side did we put it on? Debit. If a debit increases cash, then that means debits increase all assets, okay? Because cash is an asset. So debits increase assets. And think of this accounting equation. If assets are increased by debits, then liabilities are increased by credits, and owner's equity are increased by credits. Because if you look at this equation, assets equal liabilities plus owner's equity. Assets are increased by debits, so our assets are debits, and they've got to equal the credit side. So debits, the increase of an asset will always be a debit. The increase of a liability will always be a credit. The increase of an owner's equity will always be a credit. Does that make sense? Do you see how it balances? Debits equal credits. Okay? Now, the opposite is true. Cash. When we used cash up or decreased cash, what did we do? We credited it, didn't we? So credits decrease assets. And the opposite is true. Debits decrease liabilities, and debits decrease owner's equity. Okay? Hang in there with me, guys. This is one of the toughest concepts. A lot of times people think of a credit as something increases. Well, for liabilities and owner's equity, it increases, but not for assets. How many of you guys go to the bank and they say, we credited your account? When you deposit money? Why do they say that? Do you know why? When you give them $1,000 to put into your account, that $1,000, think of a transaction, is cash to them. So that's cash increases. But your account is a liability to them. It's money that's yours. They owe it back to you. Okay? So when they increase your account for the bank, that's their liability. So they credit it because they're increasing a liability. Make sense? This little chart here is so important for you guys to look at over and over again. On our little discussions this week, I'm going to be bugging you about assets, debits, credits. You see here, assets, it's our accounting equation, equal liabilities plus owner's equity. Do you see on the left side, the debit side, that increases assets? And then, do you see where the liability, the credit side, increases liabilities? And you see the owner's equity? Credit increases owner's equity. And then the opposite. For assets, credits decrease assets. Liabilities get decreased by debiting them. And owner's equity also is decreased by debiting it. Okay? Do you see how in the equation assets work one way, liabilities and owner's equity work another way? Okay? Withdrawals and expenses are deductions from owner's equity. So transactions that increase withdrawals or expenses ultimately decrease owner's equity. So in that case, they're going to be debited because it decreases our owner's equity. So as you see here, for now, our owner's equity has a normal credit balance. But when we withdraw from owner's equity, aren't we taking away from owner's equity? And when we have expenses, aren't we taking away from owner's equity? So since we're taking away from owner's equity, we're going to debit our withdrawals and we'll debit our expenses because we're taking away from owner's equity. When we increase capital or when we get revenues, we're increasing our owner's equity. Therefore, we'll credit revenues is the normal balance for increasing, and owner's capital will credit to increase. Right now, we're looking at this owner's equity section as a lot of things in it. But remember, when we increase our owner's equity, we credit it. When we decrease our owner's equity, we're going to debit it. And two things decrease owner's equity: expenses and withdrawals. Okay? So those two types of accounts, withdrawals and expenses, have a normal debit balance because they're also decreasing owner's equity. The normal balance of an account is its usual balance and is the side, which we call a debit or credit, that increases the account. So the normal balance of an asset is going to be the side that increases assets, and that's going to be a debit. The normal side that increases liabilities is a credit, isn't it? With owner's equity, do you see how our owner's capital and revenues increase owner's equity? But do you see that withdrawals and expenses are going to decrease owner's equity, so we debit them? Okay? So as you can see here, the normal balance is going to be what is increased. And you can see the increase of an asset is a debit. Therefore, the normal balance is going to be a debit for assets. To increase a liability, you credit it. Therefore, the normal balance of a liability is going to be a credit. For owner's capital, to increase owner's capital, we credit it. Therefore, that's going to be the normal balance of owner's capital as a credit. For withdrawals, it decreases owner's equity, so we're going to debit it because it decreases it. But the normal balance of all of our withdrawals together is going to be a debit because the withdrawals are accumulated to show we're taking money away. Revenues increase owner's capital, which means it's a credit. That would be the normal balance of revenues, a credit. And think about the expenses. That takes away from owner's capital or owner's equity, so we're going to debit it. And expenses have a normal debit balance. I think we're going to take a little break, okay? How you doing?